In this recording, we're going to focus on a particular area of strategic finance, looking at dividend policy, i.e. how a company returns its money to shareholders and in what form. So we're particularly looking here at a Summer 11 question 3, which is a very good benchmark question of dividend policy because it looks at both the computational side using the dividend valuation model, but it also looks at the narrative side around critically appraising dividend policy theories and understanding and applying that to a particular company. So for 10 marks, you're asked to critically evaluate. So that means look at the good and the bad of the supporting basis for made for each director about the future dividend policy of Sprinter. This is quite a popular question, came up again in 2014 and came up in 2016 as well. You're asked to, here's 3 or 4 different perspectives on what the dividend policy should be, and you're asked to critique them. And you should discuss whether or not each proposal is consistent with maximizing shareholder value. So that's all your knowledge around the different concepts of what dividend policy should be about, what should it take into account, and what's a good and bad dividend policy. Part B then looks at more computational aspects around using the dividend valuation model and valuing a company from 2 different perspectives. So there's about 9 marks going for valuations, so we'll come back to that. And finally then, as an alternative to a normal dividend, you can do a share buyback instead, where as the name suggests, you buy back shares from shareholders, which is essentially giving them cash back in a different format. And you're asked to comment briefly on the director's proposal for a share buyback for 3 marks. So 22 marks in total. As we said, this is an optional question this year, so roughly your guidance is 2 minutes a mark. So about 44 minutes, 3/4 of an hour to answer something like this. So if we go back up, you're told here Sprinter Limited was founded in the year 2000 after the Sydney Olympics, and they're involved in high technology biomechanical devices. And they've spent an awful lot on R&D. And essentially the 3 company directors now, John, Sonya and Eamonn, are looking to discuss future dividend policy. No dividend has been paid to date, and the dividend policy competitors have been ignored. And what you're given then is a nice table with their proposals, each of them. John's proposal, Sonya's proposal and Eamonn's. And you're asked to figure out, is this a good or bad one? And you're given a bit more information down here then. John owns 70%, so he's the majority shareholder. Sonya owns 5%, and then the remaining 25% held by number of silent partner investors. Eamonn is the business development director. He's no shareholding, and Sonya is keen to take the company public in the near future. So you're given all of that information for a reason. So make sure you have that in the back of your head when you're making your commentary. And we'll have a look at this then at the end around the calculations and the share buyback. That'll be for part B and part C. So the first one we're going to look at then is John Coughlin. Now his dividend policy is pay 15 cents per share and then grow it at 5% per annum. So you're paying out 15 cents and the earnings per share here are 60 cents. So you're paying out about 25% as dividends. So a relatively low one compared to some of the other suggestions. So what we'll start off with here is John. Now again, I'm only doing it at a high level. You might go a bit more detail, but when they say evaluate critically, it means what's good and bad about it. So here John says it does not reflect well on the company that we've not returned any dividends. A confident company pays dividends. Steady dividend with low growth is optimal, and paying lower dividends will eliminate the need for additional equity. So you're trying to say, do you agree with those particular bases for proposal? Well, the first thing is his logic around a confident company paying dividends, and it does not reflect well that we have not paid a dividend. Well, you could argue there's merit in that. So you could say there is merit to say that paying a dividend might signal confidence, plus maturity in the context of this business because it's a young business and they're maturing now, trying to go for an IPO possibly soon. So there is merit there to say if you start paying a dividend, often we say dividend will signal. It's the whole idea of signaling theory you would have covered in the lectures. It sends a signal to the market. Oh God, the management must be confident here of the future prospects if they are paying a dividend. It is good practice to start small and grow steadily because investors like certainty around dividend policy. So what they don't want to see sharp increases followed by cutting dividend. So that's generally what investors do not want to see. Investors will want to come in, they'll want to know, right, you're getting a certain amount of dividend, a certain amount, and you're going to have a readily enough idea of where it's growing. So if you look at the likes of Glanbia, CRH, Kerry Group, they have a slow and steady growing dividend every year. Even in the bad times, it's low enough that they can maintain it. There's no massive surprises each year. So again, John is relatively right there that a steady dividend with low growth is optimal because that's what investors want. You don't want to surprise investors every year by saying, oh, we're paying out 80% of profits this year's dividend. Next year we're paying no dividend, because it doesn't allow them to plan their income. And John also says then, paying low dividends will eliminate the need for additional equity. Low dividends may reduce the need for outside equity, but may not eliminate it. And the reason here is you don't know how much you're going to need. It depends on the growth profile. It depends on the capital expenditure requirements. But John is right that if you pay a lower dividend, that means, remember, your plowback ratio, because remember, your plowback plus your retention equals profits, which is 100%. So you're saying you can only do two things with profits. You either retain them, which we call the plowback ratio. Sorry, that should be the plowback plus the payout ratio. So plowback is otherwise known as the retention ratio. How much you retaining in the business versus how much you're paying out. John is suggesting here to start with paying 15 cents per share, which would be 25% payout, because earnings per share is 60 cents, and maintain the rest in the business and grow it then. So generally here we would say John has a lot of merit here. Slow and steady growth, no sharp increases, and start to pay a dividend to signal the maturity of the business that it can afford to pay a dividend each year. It gives a good signal to the market. Sonya, on the other hand, is slightly different. She suggests to pay out 75% payout. So whereas we said here, John is a 25% payout. So you put your dividend per share over your earnings per share. So she's saying a flat 75% per annum per year. Company with high payout will have higher valuation. We can borrow cash for expansion because interest rates are low and interest payments are tax deductible. And paying the dividend will reduce the cost of equity to 13%. Right? Well, so her basis here is higher dividends mean higher valuation. So higher dividends does not always equal higher valuation. So the point is here, it's not always a linear relationship like that. Because you have to remember here, if you start paying out 75% of profits, well, that means you have very little to invest. You're only reinvesting 25%. So paying out that amount of dividends may restrict future capex, especially if debt is limited. So what we say about that, the more dividends you pay out, the less you have to reinvest into growing the business in the future. And you're told already in the question, the company up here, can I see it? All development projects are financed out of retained earnings, so they're not used to taking on debt. So she's saying we can borrow cash for expansion. You're not sure about that. You haven't taken on debt before, and particularly if you're in the high technology biomedical devices, that may be too risky for the bank. So you might say there, no certainty you can get enough debt for capex. So there's no certainty around that. Yes, she's quite right that interest rates are tax deductible, but you can't rely on getting debt because you have to go out and apply to the bank, and they may not want to lend you money depending on what investments you're going into. The benefit of retained earnings is you have control of it already. What's also not clear is, why would the cost of equity decrease? Why would KE decline? So she hasn't explained the basis of that. If anything, you would expect the cost of equity to go up because you're now telling her to take on more debt. And the more debt you take on, the riskier equity. More debt would equal higher risk for shareholders, which means higher KE. So that's a good student who says, Actually, I've thought about this. Sonia's plan is to pay out more dividends, but that means if you still have the same capital expenditure requirements, you're going to have to borrow the money somewhere. And the more debt you take onto a capital structure, the more risk for the shareholders. And more risk for shareholders means a higher rate of return. So in general, you would say here, Sonia's doesn't really seem to be making sense. But it might make sense if you look at it from the perspective, she owns 5% and she wants to list the company soon. So she may be influenced to try and maximize the short-term share price so she can make money off the IPO. So you might put down that to say, Sonya could be influenced by her 5% and goal to IPO soon. So she may want to maximize the short-term share price, which you might if you start paying high dividends up front. But in the longer term, the more debt you take on and the lower growth you have, it's going to have a negative impact on the share price. So again, look in the perspective, why am I giving it information? Why am I told she owns 5%? And why am I told she's keen on an IPO? So always have those pieces of information in the back of your mind. So probably not the best one to maximize shareholder wealth here. And then Eamonn, who's the last one. So you're told, Eamonn here, no dividend. You only pay dividend when there's no alternatives. Raising debt is costly. You should be using retained earnings instead. So Eamonn is talking about residual theory. So you will have very volatile dividends because you only pay dividends when you have no other use for it. So in years where you have a high capital expenditure requirement, you won't pay any dividend because what you're going to do is take all the profits for the year and plow it back into capital expenditure. In some years then when you don't have money to spend it on, or you don't have projects to spend it on, you give it back. So very volatile dividends, do not suit shareholders. Shareholders want more predictability. They don't want to get a 50,000 dividends one year and no dividends the next year. It doesn't allow them to plan their income. And Eamonn's suggestion, did you pick up on this? May be influenced by the fact he is not a shareholder. So you're told that in the question. So he may have his own agenda because he's not a shareholder. He's the business development director. So he just wants to have enough money to invest in new development. So he's influenced as well. He's biased. He doesn't care about dividends. That's why he's taking this extreme view. And that's probably not good either. Because if you don't pay dividends, you're not going to look attractive to shareholders, particularly when you're listed on the stock exchange. So neither Sonya or Eamonn's will be maximizing shareholder wealth. The best one is probably going to be John's. And what a good student will say at the bottom is, if planning on IPOing, need to consider competitors' dividend policy. That's another thing. Did you spot it in the question? They told you in the question up here, dividend policies followed by competitors were ignored. They've never paid a dividend, they haven't looked at it. If you want to list in a stock exchange, you're going to be directly comparable now to your competitors who are on that stock exchange as well. So you need to have a good basis of why your dividend policy is different than the others, because investors are going to be comparing them. So that would be a nice point at the end to get a mark. John's looks to be the best one. Slow and steady growth rate. You have a small dividend to start, so you don't have to cut it, and you grow it regularly. But as well as that, you should at least be cognizant of what your competitors are doing in the stock market. Otherwise, you're going to lead to questions, particularly if you do plan to list Sprinter on the stock exchange in the future. So that was a good question, and I said go back and look at 2014 and look at 2016 as well, where similar questions came up. You had to critique particular dividend policy proposals and see whether they were good or bad. The next one then says, using the dividend valuation model, estimate the value of Sprinter's equity for John and Sonia's proposals. Now we know in B, the price of a share today is div1 over cost of equity minus G. That's what we call our dividend valuation model. And div1, if you just want to write it down, div1 is div0 times 1 plus G. So it's two ways of putting in. So the price of a share today, P0, is the dividend next year divided by the cost of equity minus the growth rate. So it's essentially treating dividends as a perpetuity with growth. John's proposal is to start with a dividend next year of 0.15. Now the examiner was flexible here. If you treated the 0.15 as div 0 and you grew it by 5%, you'd have got full marks as well. But you could have treated 0.15 as div 1 and divided by the cost of equity, which we're told the cost of equity here is 15%, 0.15 minus 0.05. Your growth rate, you're told here, 5%. So for John's, it will be 0.15 divided by 0.15 minus 0.05. So the value there, so your value there then in per share will be 150. And there's 2 million shares. Just be careful there. If you look in the question, it tells you you have 1 million share capital, but each share is a nominal value of 50 cents. So you must have 2 million shares to have 1 million share capital. So the value there of that company using that method will be 3 million under John's proposal. Sonia's proposal is slightly different. She says she's going to pay a flat 75% out each year, 75% of 60 cents. So you're paying 3/4 out is 0.45 divided by, and you're told the cost of equity is 0.13. And there's no growth rate. Why? Because you're told it's a flat profit per year, flat 75%. So we're assuming there that there's no growth in Sonia's circumstance. There's only growth in John's because he's plowing back a lot more. John is reinvesting 75% of profits, paying out 25%. Sonia's the opposite. She's paying out 75%, only reinvesting 25%. So that means here, 0.45 divided by 0.13. The value per share there is about 3.46. So significantly higher. And that means multiply that by 2. The value in millions, about 6.923 million, is the value of the overall company and Sonia's proposal. So you can see there, as you change assumptions, you can have significantly different impact to your share price. Now, how realistic that is questionable. Because number one, how maintainable is a profit of 60 pence per share, or earnings of 60 cents per share, if you're not reinvesting that much? Because you're only reinvesting now 25% of profits. That might be a very low reinvestment rate, particularly for a high technology company with significant R&D. So that may be misleading, and that's what we said already about Sonia's short-term perspective. She wants to maximize the short-term share price because she's looking to list the shares and probably cash out her 5% shareholding. So that was the first part in B. Second part says, using the P ratio, estimate the value of Sprinter. You're told comparable company here is 5 times earnings. So using the P method, it would be 5 times 0.6. So if you did that, the price per share, 5 times 0.6, about €3 per share. Now, there is the alternative here to take a discount, that you mightn't use 5, you might use, for example, 5 times 70%. Because you might say, well, I'm valuing a company that's a limited company, Sprinter Limited, whereas this is listed companies, quarter companies. So you might say, instead of using 5, I'll use 3.5, and 3.5 times 0.6 would get me 2.1 per share. So there would be a number of acceptable answers there. Some students might say, well, Sprinter is still a limited company, so I should be using the discounted PE ratio because you're discounting it for marketability. Others might say, well, actually, Sprinter is going to be listed soon, so the more realistic one is not to take the discount and use the 5 times. So either way, it's either going to be worth 6 million overall, because there's 2 million shares, or it's going to be worth about 4.2 million when you multiply the 2.1 per share by 2 million shares. So either one of those would be acceptable to the examiner. So that was your small little valuation piece put in. It's only 2 marks. But then they ask, comment briefly on any variability in the answers you've got for the dividend valuation model and for the PE ratio. So what they're trying to get you to identify in B part 3 here is the different assumptions. So the key point is here, whatever dividend policy is held and whatever assumptions are used, that can significantly change the valuation. Where you have a low dividend and low growth rate, you have the 3 million valuation, but where you pay out a huge amount of dividends up front and you lower the cost of equity, that has a huge impact on the share price. Now, whether or not we agree or whether that's realistic is a different thing, but the point is by changing the assumptions, you can have a big impact on your share price estimate. So what you're trying to identify there, the main reason for variability is differing assumptions. How reliable Sonia's assumptions are questionable, because if you start paying out that huge amount of profits as dividends, you're retaining very little in the business. And for a company that's high growth and focused on R&D, such as Sprinter, that's probably going to decimate the growth prospects in the future. So whether that's realistic or not is questionable. So your points are the variability is driven by different assumptions, particularly different payout ratios and different growth rates. So you would have to check how realistic they are before you would make any credible recommendation based on valuations. The PE one is probably the one that's most credible because you're using a company that's already traded in the marketplace. But the big problem with variability there is, should you take a discount or not? And particularly, how much should that discount be? So even within that model, it could be 4.2 million of a company value, it could be 6 million. So it just shows you company valuations are not perfect, but the main driver of variability there, which has been asked for, is the estimates that are used. The estimated growth rate, the estimated discount on marketability, and the estimated dividend payout ratio. So finally then, comment briefly on the director's share buyback proposal. So the directors here, Sprinter, they're keen to set a floor in advance of any flotation. So like an IPO, they're keen to set a price floor, say this is the minimum price we're going to list our shares at. And what they're planning to do is buy back shares held by the silent investors, who are the 25%, with a combination of cash and debt. So what's the logic of this? Well, this to some extent makes sense from the director's perspective. They want to remove some of these investors before they float on the stock exchange. So you want to remove any people who may, again, complicate things or slow down the process. But the question mark is here, is this going to be an artificial price? So one point that you'll have to make is, if this floor price is actually artificially high, the market will see through this. So the market will look at what the price was set at and how it came to it. They're not going to take that price as a given and not question it. So plan has some merit, but if price is artificially high, the market will see through this. And by see through it, I mean they'll realize that's an artificial price and they'll know what you're trying to do. And also, it kind of defeats the purpose. If you're trying to set an artificially high price, you're actually going to give money away to the other investors. So you're doing yourself, the other shareholders, out of money. So it doesn't make commercial sense from that perspective. There would be a question mark around using debt to fund share buybacks. There is company law restrictions. So from a company law, it may not be allowed. And also from a more financial risk perspective, that really doesn't make much sense because you're going to put debt on the business and currently the business never had debt before. So whether you're used to managing debt or whether a company that's involved in this high technology and significant R&D, whether it's suited to debt is a question mark. So overall, it's probably not the best proposal. It makes sense if it's done at what we're looking. Makes sense if it is done at an arm's length agreement. So what we mean by that is if you agree a commercial price, this is the value of the silent investor shares and buy them out at that price, well, there's no real issue with that because it might make it easier than to list in a stock exchange that you don't have a number of different shareholders with different viewpoints coming up to that very important process. What doesn't make sense here is to try and set an artificially high price just so you can set this floor for future flotations. investment banks and potential investors, likes of equity, private equity funds, hedge funds, they will see through those artificial prices and it will be meaningless. And all you'll be left with is overpaying for shares, and you'll be saddled with debt in the company. So that's really not the best proposal to buy back shares. So you can see that was a quite tricky one, but you just had to give the comments to say, look, the plan has some merit, because essentially what they're trying to do, remember, when you do a share buyback, you reduce the number of shares, which means EPS goes up. Because for the same level of profits, the number of shares you divide by reduces. So that means you can boost your earnings per share, but usually investors in a marketplace will see this and they'll adjust around their market price so it won't have a big impact. So there is some merit, of course, on trying to do this. But I said there's questionable tactics about what they're trying to do by setting a floor. It's going to be seen through it and it's not going to have the intended impact. I said you only need to give 2 or 3 bullet points there. It's not a huge piece in the overall scheme of things. The big requirement there particularly was part A and B part 1. Did you know the theory around dividend policy? So particularly, could you explain what's a good dividend policy, what's a bad dividend policy? And could you also do the calculations? Do you know what a dividend valuation model is? Do you know what the formula is? Remember, it's an open book. You should have the cheat sheet going in with you. And can you do the calculations for different assumptions? So that was dividend policy, Summer 11, question 3. Have a look now in 2014 and have a look at 2016 as well. Both of them or the summer paper dividend policy appeared.